In this week's market update, central banks are the main focus as the Fed, Bank of Japan and Bank of England all announce interest rate decisions. Technology is in the spotlight after heavy falls at Netflix, Facebook and Twitter, and another heavy week of corporate results is in prospect. This week is all about central banks as the US, Japan and Britain all shine the spotlight on monetary policy at key rate-setting meetings. Things actually kicked off last week with the European Central Bank. A no-change meeting of the ECB was no surprise to the markets, having pared back its bond buying programme last month and promised no rate rises until the middle of next year. There was little prospect of any alteration of that cautious policy this time around. The ECB's continuing caution puts it at odds with the direction of travel over the Atlantic and has raised some eyebrows. It risks leaving Europe without any firepower come the next downturn if interest rates remain on the floor and so can't be reduced as and when the economy needs some policy support. It now looks as if European interest rates will stay at emergency levels even as unemployment hits historical lows and inflation rises close to target. Some economists argue that this is unduly relaxed. This week sees three other central bank announcements in 3 days. Japan kicked things off earlier today, confounding speculation that it is edging closer to ending its ultra-loose policy. Just to make sure that no one can misread its intentions, its policy statement was headlined, "Strengthening the framework for continuous, powerful monetary easing." The Bank of Japan has intervened 3 times in the past week to keep a lid on bond yields as the market tests the central bank's determination to keep the yield on 10-year government bonds close to zero. Today's announcement told the market that it would continue with massive stimulus. The Bank of Japan has been the easiest of all the world's major central banks in the years since the financial crisis, employing negative interest rates and a 6 trillion yen a year program of ETF purchases in its bid to pull up an inflation rate that remains stubbornly well below the bank's target. The only changes announced today were minor tweaks that broaden its hunting ground for ETFs to the Topics index rather than the Nikkei, and a slight change of wording to provide a bit more flexibility for its yield target. Next up is the US's Federal Reserve, which is expected to leave rates unchanged on Wednesday. But it is the most aggressive tightening path of all banks. Having raised rates twice this year, the Fed is expected to do so twice more as the central bank leans against an economy that last week was shown to be growing at more than 4% a year in real inflation-adjusted terms. This is the fastest rate of growth in nearly 4 years and was unsurprisingly hailed by President Trump, despite claims from economists that it would be difficult to sustain this rate of growth in future quarters. Some of the gains are a product of Donald Trump's tax cuts, but stronger exports were also a factor as buyers of soybeans, for example, tried to get in ahead of expected tariffs as the president ratchets up trade tensions with the rest of the world. Finally, the Bank of England will unveil its own interest rate decision on Thursday, with the odds remaining on a second quarter-point hike to 0.75%, as the Monetary Policy Committee grows in confidence that the British economy is finally bouncing back. If you disregard 2016's panicky cut to 0.25% after the referendum, which was reversed in November last year, this will be the first real rate rise since July 2007. A rate hike was thought likely in May, but the bank erred on the side of caution as the uncertainty around Brexit kept recovery in check. Even this week's expected rise is by no means certain, with underwhelming wage growth and inflation pointing to an economy that is not yet firing on all cylinders. Even if the bank does raise rates, it's still likely that the trajectory of any further increases will be very shallow. The gap between US and UK rates is likely to widen further over the next couple of years, pointing to continuing downward pressure on the sterling-dollar exchange rate. Now, stock markets are so far coping well with the early stages of monetary tightening, which many feared might sound the death knell of the post-crisis bull market for shares. Stock markets remain close to all-time highs, led by Wall Street, as corporate earnings in America benefit from tax cuts and high levels of employment. The broader stock market has also seemingly shrugged off a handful of dramatic falls from grace in the high-flying technology sector, preferring to think that Netflix, Facebook and Twitter are demonstrating company-specific issues rather than heralding a meaningful correction in this most high-octane part of the market. All three of these companies have been punished for disappointing investors' sky-high expectations in the past couple of weeks. In Netflix's case, its shares fell by 14% in a day after announcing slightly worse than forecast subscriber numbers for its video streaming service. Facebook actually delivered a 40% increase in revenues, but it warned that the pace of sales growth would fall sharply in future quarters and that would hit its profits margin. Its shares were down by 24% at one stage. Twitter ended the week on a sour note with a 19% share price fall after user numbers declined year on year. The corrections in these previously high-flying shares contrasted with the fortunes of other leading tech stocks such as Amazon and Google owner Alphabet, which surprised on the upside and saw their share prices build further on recent strength. This in turn raised questions about how useful catch-all groupings like the FANG acronym are for a sector which encompasses such a wide variety of business models. The last of this group, Apple, will make that point when it announces results today, unveiling how many iPhones it shifted in the past 3 months and a completely different business from social media, online advertising and video streaming. All of that said, tech stocks have certainly taken a beating. The FANG's Plus index declined 2.4% yesterday, taking it 10.5% down from its intraday high on June the 21st. Now, maybe it's stretching it to call this a tech stock correction, but it does feel close to it. One of the major differences between the companies reporting results during the ongoing earnings season is between those adversely affected by rising trade tensions and those seemingly immune to its impact. Companies like Ford, General Motors and Whirlpool have all taken the opportunity of their results announcements to warn on the negative effects of new trade tariffs. Sometimes, though, the market can be blindsided. Caterpillar shares, for example, have been sold off recently on fears that the earth-moving equipment company would be hit by tariffs. They're down 9.5% year to date. But yesterday's record second quarter earnings easily beat expectations and the company trumpeted a healthy order book. It said it would offset the impact of recently imposed tariffs by raising its prices. Trade wars were high on the agenda this week as European Commission President Jean-Claude Juncker headed over to Washington with low expectations, but he appeared to come away with a ceasefire, if not quite an armistice. The two said they were ready to start talks on reducing tariffs between the US and Europe. In an apparent victory for Europe's car makers, it was agreed to put new auto sector tariffs on hold while discussions proceeded. Shares in BMW, Fiat and Volkswagen were all up sharply on the news. Now, whether the market's sanguine reaction to the slight easing in trade tensions is over-optimistic remains to be seen. But analysts at Citi warned this week that investors risk becoming complacent following the market's big rally from its lows earlier in the year. The bank said that none of the geopolitical fears that spooked markets in the spring had really been resolved. Despite that, the S&P 500 has risen by 10% since April and now stands close to its January all-time high. Europe's Stoxx 600 index is up 8% over the same period. Much will depend on whether earnings can continue to grow at their current rate of more than 20% a year. With 140 of the S&P 500 due to announce this week, almost as many as last week, we should have a clearer picture by Friday. Over here too, there's another torrent of company announcements. We've got results due from a wide range of blue chip companies including BP, Rio Tinto, BAE Systems, Lloyds, Barclays and Rolls-Royce.